I think in order to get access to these strong technological drivers, you're able to invest in often higher quality businesses in emerging markets at lower valuations than we see in US markets.
Hello and welcome here from Cologne from our FundView studio. With me today is Chris Tennant from Fidelity. Hello, nice to have you.
Thanks for having me.
Today we want to talk about the emerging markets. Emerging markets had pretty rough last years, but the last couple of months were pretty good and strong. Do you still see value in emerging markets after this kind of strong comeback?
We definitely do. So I think, emerging markets have had a good period, but it's come after almost a decade of underperformance for emerging markets. And it's really been driven by a strong recovery in earnings, particularly in the technology and materials sectors. And actually, we haven't seen any sort of re-rating in emerging market valuations at all. So the markets are still extremely attractively valued relative to developed markets. Another reason to be optimistic is a lot of things that have carried US equity markets in recent years, the strong performance in the technology sector. The majority of the supply chain sits in countries like Korea and Taiwan, and so we still see some very strong fundamental drivers for the technology space. And then finally, there are also attractive opportunities in countries like Brazil, where valuations have become really depressed after quite a big sort of interest rate hiking cycle, and potentially positive catalyst on the horizon with the election in October.
You've mentioned the tech companies, especially in the US, the big drivers of the market. Everyone is focusing on US tech, but they're quite expensive. Do you see good alternatives in emerging markets, especially on the tech side?
Definitely. I think if you were to compare similar businesses in the US and in emerging markets, you're often able to find much better value in emerging markets. And the most obvious example would be if you were to compare a Micron versus an SK Hynix. And I think SK Hynix has been driving a lot of innovation in the memory sector, and it trades at a much lower multiple still relative to its US peer, Micron. Another example it would be in the sort of Ethernet switch space, where you have fairly similar businesses in Celestica and Acton. I think Acton is the higher quality business. It's more profitable. It's grown more strongly in recent years, given its integration into the TSMC supply chain, and it trades at a much lower multiple of its US counterpart. And so I think in order to get access to these strong technological drivers, you're able to invest in often higher quality businesses in emerging markets at lower valuations than we see in US markets.
Talking about the emerging markets, we definitely have to talk about China, the biggest market in the emerging markets. But a lot of German investors are kind of very skeptical regarding China. They reduce their exposure. They're skeptical because of political reasons. How do you see China? Do you see more chances, or do you see kind of the risks?
We see both opportunities and risks in China, and that's one of the reasons why I think it's important to have a very active portfolio. And the areas where we would be more concerned would be around consumption and the property sector. And so we still think there are downside risks to property market. There's still a big inventory problem, and this can weigh on consumer sentiment for the time being. And at the same time, you have quite a lot of demographic challenges in China: a low birth rate, declining working age population, and fierce competition in the retail sector. And so, whereas in developed markets you have sort of fairly consolidated retail sectors, in China there's much more competition, and as a result, profitability is much lower. And so we're concerned around some of the domestic areas in China, but where we are much more optimistic would be around some of the export sectors in China. And China is investing a lot more in R&D and is spending more on R&D as a percentage of GDP relative to many developed market countries these days, and is driving a lot of innovation in various different sectors, whether it be batteries or various sort of higher tech industrial equipment. And in these sort of higher tech industrial exporting sectors, that's where we see a lot of opportunity and where we have exposure today.
And the situation in the Middle East, of course, is very important also for the emerging markets. Do you see that a possible agreement would have a very positive influence on the emerging markets?
I think so. If you look back to before the conflict escalated, back to January, February, emerging markets were performing very strongly. All the stars were aligning for emerging markets. You had big investments in the technology sector from the hyperscalers, driving capex for the supply chain that sits in Korea and Taiwan. The backdrop for commodities was very positive, particularly the commodities that are important for emerging markets like copper, which is not just a driver for the materials space, but also countries like South Africa, Chile, Peru, etc. You also had the potential for rate cuts, and that is the one factor that really did change with the conflict. Higher oil prices driving inflationary pressures. Saw the market taking a more hawkish view on the outlook for rates, and that has sort of weighed on emerging markets during that period. And so I think if we do get an end to the conflict and we can see a more benign outlook for energy prices, then that headwind for emerging markets from higher interest rates is off the table. And I think the market will go back to looking at the positives for emerging markets, which centered around lower valuations, a very positive outlook for technology, and the great backdrop for commodity prices.
So generally positive outlook for emerging markets, especially for tech companies from the emerging markets as an alternative to the big US companies, has Chris Tennant from Fidelity. Thank you very much.
Thanks for having me.